Get started. Setting an optimized entry in trading is crucial because it directly impacts your risk-to-reward ratio and the overall success of your trades. An optimized entry increases the potential profit you can make if the trade goes in your favor. It helps you place your stop-loss orders closer to your entry point, reducing potential losses if the trade goes against you. By fine-tuning your entry, you can control your position size more effectively and manage your overall risk exposure. An optimized entry increases the probability of the trade moving in your favor, improving your win rate over time. It encourages disciplined trading by following a well-defined plan, which is essential for long-term success. Imagine we have a perfect sell setup here that meets the criteria and rules of a high-probability setup. These are the criteria we always look for in the market to identify such a setup. Firstly, you can see that the price is in a strong downtrend and has already reversed from a strong supply zone on a higher time frame. The next criterion is that the price must fill the fair value gaps. Yes, the price has done that. It swept the internal liquidity by filling the fair value gaps created during the downward movement, and now it's ready to move toward external liquidity. The next rule is that the buy-side or sell-side liquidity must be swept. And yes, we can see it on the chart. Price swept the liquidity above the previous structure here and immediately pushed back down, closing below the highs range. This allows us to identify a liquidity sweep pattern and a newly formed supply zone. This presents a good opportunity to go short if we decide to place an entry. The key idea behind this rule is that when buy-side liquidity is cleared out through a liquidity sweep, the price is then attracted to the sell-side liquidity, which is in line to consider a long position. It's pretty clear that here, the price is above the 50% of Fibonacci retracement. The last rule is the presence of a higher time frame liquidity zone in front of the price that can be utilized as a potential take-profit level. When all these rules and criteria align, we have a high probability trading setup. However, the biggest challenge traders face after identifying this perfect setup is knowing how and where to enter the trade. This is the most critical and tricky part of trading. If you can't set up an entry optimally, you might still experience losses, even if you've identified a flawless trading setup and predicted the price's future direction. There are three main entry setups. The first one is the aggressive entry model, which carries more risk. The second is the conservative entry model, which offers entries with additional confirmation. And the third is the ultra-conservative model, which provides a setup with multiple confirmations across various time frames. Now let's get started with the aggressive entry model. Executing a trade using this entry model is like to placing a limit order within the higher time frame's demand or supply zone. Imagine we have a perfect sell setup, like the example on the chart, confirmed by the criteria and rules of a high-probability trading setup. For placing a short position using this entry model, your entry point should be right at the lowest point of the supply zone. To manage risk effectively, set your stop loss a few pips above the highest point of the zone. When it comes to take profit, you can target the closest external liquidity at the same time frame, as we anticipate that price will move in that direction. Alternatively, you can aim for the higher time frame's major liquidity zone to achieve a higher reward-to-risk ratio. Risky entries come with their advantages. You're less likely to miss trading opportunities, and you don't have to constantly monitor the charts. However, there are drawbacks to consider. It provides higher risk because you've entered into the market without a reversal confirmation, and also you are not watching the price reaction when it reaches the area of interest. For instance, consider a situation where it coincides with the London-New York crossover, and a news event caused volatile price movement. There's a high chance the price hits your stop loss, and then starts moving down. Since this entry method involves a larger stop-loss area, it obviously provides a lower reward-to-risk ratio. Now let's move into the conservative entry model details. In this entry model, we employ two different time frames for our trading approach: a higher time frame for market analysis and a lower time frame for entry confirmation and order execution. I personally prefer using the 15-minute time frame for market analysis and then switching to the 1-minute time frame for executing my trades. However, you have the flexibility to choose other time frame combinations, like the 1 hour and 5-minute or the 4 hour and 15-minute, depending on your preference. The key principle to remember is that your market analysis time frame should be at least twice as long as your entry time frame. Before we continue, to apply the conservative entry, we should wait for price to tap into the point of interest zone and show a rejection. Then our next step is to switch to a lower time frame. Closely monitor the price movement and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the lowest point of the newly recognized order block, in this case, a supply zone on the lower time frame, which is created by the change of characters wave. With a stop loss set a few pips above the highest point of the zone. And for the take profit, we set it at the external liquidity of the higher time frame. The pros of this entry setup are that it ensures a reaction at the point of interest by closely monitoring lower time frame price action, resulting in a higher reward to risk ratio due to the use of a tighter stop loss on the lower time frame. However, there are cons to consider. If the price decides to flip the identified point of interest and continues its upward movement, your stop loss placed on the lower time frame may get hit. Because by using this type of entry, there's also the possibility of a continuation flip pattern forming on the higher time frame. Or if the price requires more buy-side liquidity to be swept, using this type of entry may trap you in the market. Another drawback is that you're more likely to miss out on trades if you refine your entry zone too much. Now let's dive into the third entry setup, the ultra-conservative entry. Imagine we have a perfect sell setup on a higher time frame like the 4-hour time frame, which is confirmed by the criteria and rules of a high probability trading setup. Our next step is to switch to a lower time frame like the 1-hour time frame. Closely monitor the price movement and patiently wait for the price to return to the higher time frame supply zone and demonstrate a change of character pattern. After detecting the confirmation for market structure shift on the 1-hour time frame, to apply the ultra-conservative entry setup, we need to follow a few steps. First, we should identify and highlight the supply zone generated by the change of characters bearish wave. Then we need to zoom into a lower time frame like the 15-minute time frame and patiently wait for the price to tap into the identified 1-hour time frame supply zone to get reversed from it and create a change of character on the 15-minute time frame. Our next course of action is to identify the order block generated by Chalk's wave in the 15-minute time frame. In the next step, we should zoom into the 1-minute time frame and wait for the price to enter into the 15-minute time frame supply zone to get reversed from it and show a change of character pattern. Once the change of character is confirmed in the 1-minute time frame, we can proceed to identify the order block attributed to the change of the character's wave. Subsequently, we place a sell limit order at the lowest point of the zone, with a stop loss set a few pips above the highest point of the zone. As for the take profit, we have the option to target the unmitigated demand zone on the higher time frame like 15 minutes or 1 hour, or the swing low of the current time frame. These steps will help us execute an ultra-conservative entry with a well-defined risk-reward ratio. The ultra-conservative entry model has its advantages. It utilizes multiple time frame reversal patterns for trade confirmation, significantly boosting the likelihood of successful trades. Moreover, it offers a more favorable reward-to-risk ratio by meticulously refining entry points on lower time frames. However, there are notable cons to consider. First, this approach demands more time for monitoring price movements across various time frames. Additionally, seeking extensive confirmation before executing trades might lead to missed opportunities, even if prices move in the anticipated direction. Another downside is the potential to miss many trades when overly refining the entry criteria. Now that we have fully covered all the entry setup options available for placing buy or sell positions in the market and have acquired a solid understanding of them, imagine we've identified a high probability trading setup on the chart that aligns perfectly with the criteria and rules of a high probability setup. What we're doing next is searching for an entry point and, most importantly,